In high seas or calm, both opportunity and risk lurk just below the surface. Answers require in-depth analysis. Welcome to BlackFin Group's Shark Cage podcast, where experts dip below the surface of important industry issues in search of hidden opportunities.
Good day, folks, and welcome to the Shark Cage, BlackFin's podcast series. My name's Keith Kemp, President and CEO at BlackFin. I will be your host today. To start, I want to thank our sponsors. A special shout out to all of BlackFin's preferred partners, Mortgage Flex, Constellation, Mortgage Solutions, FlowFi, Cloud Virgo, LendingPad, IE, Merchant Prudent AI, and our most recent exciting addition, drum roll please, Take 3 Technologies, and many, many more preferred partners, all really doing great things to move our industry forward. Okay, so let's jump into the Shark Cage here. I'm really looking forward to today's conversation with our newest preferred partner, as I said, Take 3 Technologies. But before we jump into some really thought-provoking questions, let me quickly introduce the leadership team at Take 3 who's with us today. First, we have Brad Thompson. Brad joined Take 3 Technologies as president and COO about 8 months ago. Brad brings a wealth of strategic expertise and deep understanding of intricate nuances of the mortgage technology and fintech space. And really leveraging his many years of software management, Brad has helped Anita and her team foster a culture of technological advancement and operational excellence by introducing new processes and standardizations to Take 3's product management methodology, business development, and their delivery services. Prior to Take 3, Brad was with Mortgage Cadence, where he served on the executive leadership team for more than 20 years, leading all aspects of the delivery teams and sales teams, as well as managing some of their largest accounts. Also with us today is Anita Padilla Fitzgerald. Anita is the founder and CEO of 3 successful companies. In 1999, she founded Megastar Financial, a mortgage lender. Megastar is a seller servicer for Fannie Mae, Freddie Mac, Ginnie Mae, retaining majority of the servicing rights with them. When it comes to Megastar's success, Anita is most proud of the fact that in 2020, Megastar participated in a lender units to FTE study by Strathmore, and Megastar's units to FTE were double some of her peers. Anita also owns Megastar Holdings, which owns and manages commercial real estate portfolio. In 2007, Anita started Take 3 Technologies. In 2020, Anita was nominated and won the prestigious Ernst & Young Entrepreneur of the Year Award for financial services in the Rocky Mountain region. She sits on the MBA Board of Governors, is a board of director for a bank, on the board of directors for a bank with $28 billion in assets. And in May 2023, Inman Real Estate recognized Anita as one of the best in finance. Today, Anita looks forward to talking about how she applies her knowledge and expertise to Take 3 Technology products, the Rule Tool, and loan maps. Anita, I think the only thing we missed in relation to your enormous success in this industry is how you regularly really speak on housing market conditions on national cable news channels. So, Brad and Anita, it's really great to have you both here today. Welcome.
Good to be here, Keith. Thanks for having us.
Absolutely. Well, let's get started on some critical insights here about the industry. You know, Brad and Anita, the cost to produce one single mortgage loan is now well over $14,000. And there's just zero sign of relief really coming. Yes, a lot of that is compliance related, but I tend to think that this is a deeply rooted issue that's in lenders being so entrenched in the traditional lending process. It's as you both know, it's a monolithic process. It's crushing efficiency and productivity. Now, with that said, it's also a sophisticated process. You know, how many data points it is required to complete a loan transaction. It is absolutely insane. But in fact, almost every single loan origination system that's out there is designed really to support this outdated loan process. Anita, you've run one of the most successful mortgage companies in the nation. Brad, you've been providing technology solutions for nearly 20 years in this space. So what has to change in our industry to really start driving the cost down. Brad, do you want to start us off here?
I'd be happy to. Anita and I talk about this a lot. When we connect and talk about where we want to take three and where our true value add is. I think one of the things that I've noticed over the last 7 to 8 years is the just sheer amount of new technology solutions that have entered the marketplace. You go back 20 years and you go to the MBA tech conferences, and it was the same group of individuals. You had the same group of LOSs and a few service providers, and it was a very small crowd of individuals. And over that time, the number of new tech solutions that have come into play is immense. And a lot of them are really, really good solutions, and all of them have a good value add. They have a great story. And so what has happened is that over time, and with a market that has been prolific in volume and low rates, that there's a lot of money out there. There's been a lot of money out there, and a lot of lenders have started to buy all of these solutions. And so they've built tech stacks that are made up of an LOS and a POS and this and that. And they have these huge tech stacks. And all of those solutions have come with the promise to drive efficiency into an organization, reduce cost, build a more compliant loan, all of those things. But it's actually had the opposite effect. They've driven huge amounts of cost into their technology stacks. And with all of those technology comes all of the cost of ownership. They've got to maintain all of those solutions. They've got to implement all of those solutions. They've got to have administrators for all of those solutions. And so in addition to all of this technology they've purchased, they've added tons and tons of people that aren't even doing loan work. They're just maintaining the technology solutions in the back office to keep the motor running, if you will. And so, in addition to all of the compliance regulations and all of the things that are required in order to be able to deliver a compliant loan, you now have these huge tech stacks with huge amounts of costs and huge price tags. And you made this point in your opening, Keith. People are, they want to drive efficiency in their organization, but they're always a little nervous to change how they're doing it. So they're doing the loan in the exact same way they've been doing it for 30 years, but now they're doing it with all these new tech solutions on top of it. So they never recognized any of the efficiency or any of the cost savings. So, I'm a technologist, but I've seen so much of it added into the mortgage process, and I think it's a huge contributor to this, this immense cost of production right now.
Those are really good points, Brad. It's some of that shiny new object, and we have a lot of originators who are running mortgage companies. So when they see these shiny new objects, it's like, I'm an originator. I got to go get this new tech so I don't miss out. But what they don't realize is they're inherently applying additional risks as well as cost to their organization. So really good perspective. Anita, you want to share some of your perspective and thoughts on this?
Yeah, thank you, Keith. And thank you for giving us this opportunity to speak today. I'm very passionate about our industry and really want to help mortgage bankers across the country with success. I learned when I started my mortgage company early on that it's really only worth the basis points you earn. So my focus has always been very much bottom line driven. Production obviously feeds revenue, but your expense against revenue needs to be considered. And when you're producing a lot and your expenses aren't aligned and you end up making no profit or very little profit, it seems more logical to focus on your expense side. So I grew up in operations, and that's something I love, and I love working with technology. I think it's fun. But to your point, cost to produce, I think of it in three components. Number one is cost paid to your sales source, example, loan officers who are self-source, and the cost of advertising. Some companies don't use self-source loan officers. I'm very passionate about the self-source loan officer who builds relationships with families. Number two is cost of manufacturing, which includes your cost of your staff, management of regulatory compliance, policy procedures, Workflow management is also another very important factor, and training. Training is very important in our ability is and the ability for an independent mortgage banker or anybody who manufactures loans to bring in talent, new talent, and be able to have an efficient training process to get them up to speed. And the third is the cost, as Brad's already spoken to with regard to the fintech stack.
Yeah, really good points. The cost of manufacturing, and obviously you've had a keen eye on that, and based on the study that you did with Strathmore, I mean, it's proven that you're really thinking from that manufacturing standpoint and how to efficiently get things through the pipeline, as early as that point of sale and qualifying the deal right away. But I really love the point that you highlighted around training and making sure that when people come in, that their learning curve is expedited as quickly as possible, and most importantly, as you said, the policies and procedures. Now, a lot of organizations estimate the power of those policies and procedures, because they define specifically in black and white the guardrails that a individual, regardless of your role in the organization, must operate from. So if you have a question, go to your policy and procedures. If those are always up to date, then you'll be safe. But I think people, we work with lenders all over the country, and we continually see that they underestimate the power of the policies and procedures. So, and really monitoring their workflow management process. So I love that you emphasize those points to help drive down that cost of manufacturing. So good. Okay. Well, let me ask then, if origination costs, the cost of manufacturing, the cost of technologies is what has to change to start lowering cost to produce, what do lenders need to start doing then to begin making those changes? I mean, it's one thing to say that this is what has to change, but what are those key points in the required blueprint of running an organization to effectively start making those changes in these lenders' offices, where, as you both know, implementing any kind of significant changes, it requires a Herculean effort in our industry because there's so many different moving parts. So how do you start making these changes? We know what needs to change, but how do we start making these changes as a lender? Anita, you want to start us off here?
Yeah, thank you. So, as I mentioned early, I think of cost and revenue in three components. The first one again is sales. And we work hard and we invest a lot of money, whether that's media that you're paying for or a self-source loan officer who has worked very hard to establish trusted relationships with referral partners. But a critical goal is the capture of that data, management of the data, and then making sure your data is fresh and the logic is applied so that you can present data in front of the user in an organized, timely manner in what they understand. And I'm not just talking about name, address, and phone number. We're privileged as lenders to a lot of data. So every industry, not just the mortgage banking industry, they understand the power of data. And when you look at, mergers or sales of companies, again, outside of our industry, their focus is capturing client data. So by managing your data, putting it in a warehouse, not only your loan officers can stay in flow with their referral partners and their families before, during, or after, but the lender should also be staying in flow regardless of if the loan officer left. And again, we paid a lot of money to capture that information.
Yeah.
So protecting it, storing it, keeping it fresh is mission critical.
So can you give me an example of how data would assist? I mean, can you drill down a little bit further on that, Anita?
Yeah, well, it assists. Number one is if you're managing data for your sales team and they come to work in the morning, they should be able to see their work stack, whether that's calling somebody on their birthday, is it an annual review, things they need to do. Another example, and I think something that lenders are facing today, is loan officers on your payroll and not meeting minimum wage. So as a leader, you want to know, what are they doing? Are they following a good sales strategy? How can you help them? And you need to make decisions on whether or not you're going to retain that salesperson. So maybe they've been in the business for decades and are kind of feeling tired. Maybe they just don't understand the sales strategy that they need to implement on a daily basis. Another factor, again, in the manufacturing, so the lender can take data specific to a family. And one of the things I see lenders not really incorporating in their manufacturing process are the tools that the agencies give us that are free. Day one certainty and name, appraisals that have a CU score of 2.5 or lower. What I've seen is a lot of lenders put them through the same process, the same route. So D1C and AIM, because you validated data through a digital validation source, their technology is taking that data and it's running against the rules for Fannie Freddie, and they're saying, I'm giving you an answer on your income qualification, your stability of income. So why is an underwriter looking at it again? Or why are you adding documentation to the file when you already have your D1C or AIM? So that's a huge, part of technology costs that lenders really need to think about. Where do I send that family's loan? Which route should it take? Because that definitely affects your cost to produce.
I love that. Your first point really strikes a chord with me as it relates to LO costs and really looking at the data, to say for example, we had a regional lender who was really, we started carving out the data and really started looking at it, who all was asking for these rate exceptions. And as we went through the data and really analyzed it, we come to find out that their top 10% producers were all the ones asking for the compensation or the margin or the rate exceptions. And as a result, they were costing them more than the average loan officer within the organization. So our recommendation was either, manage them up or manage them out. Sell the rate. Don't keep asking for exceptions because you're costing me money. When I've got other LOs who actually have the ability to sell whatever the rate is. So, I think that really strikes with me the fact that you've got to be analyzing your data on an active basis, and it can't just be quarterly or semi-annually or annually. It really needs to be every month, actively monitoring your data and where your costs are going. So it's a really strikes a chord with me there.
And it really goes back to your data warehouse, right? I mean, you have to know every loan that's locked. Is it short? What's going on? And have that live data. And when you walk in the morning on your dashboard, and a loan officer's dashboard is going to be different than a department manager's dashboard, than the executive's dashboard. You have to be aligned with what's going on, not just with loans that are being locked and your warehouse, your aging, and you need to see it. Boom. People have said to me, where do you find the time to do what you do? I'm like, data. I just open my dashboard in the morning. I see what's going on and I move on with, we have a great president at Megastar Financial, Mike Aberley, and we execute.
It's all about execution. You can look at the data, but then you got to have a plan around it in order to execute on it and make it useful. So, Brad, I want to bring you in here because I'd love to get your perspective. But when it comes to the manufacturing, and Brad, you might be able to relate to this, but one of the common issues I see in the industry is that lenders really don't maximize the technology that's in front of them, and that's what slows down part of their manufacturing process. Just to your point about D1, day one certainty in or the AIM loans. I mean, why aren't we leveraging these technologies to really maximize our productivity and lower our cost? I still scratch my head that, only 40% of technology is actually used that a lender adopts within their tech stack. So there's so much more room for improvement. So Brad, obviously being on the technology side, implementing, managing large clients, and your role over the last 20 years. I mean, what's your perspective on this?
Well, I'll start with answering the first part about or commenting about your 40%. The reason that happens, Keith, is these solutions come with big promises and they come with ginormous price tags, and so they show you all the things it can be, and then to get it there ends up costing organizations so much money to actually get the solution there. And so a lot of companies stop short because they say, listen, we just got to start using it. And so they cut their implementation short, or they go to they do a beta release or a day one or whatever, and then that's kind of where they stop, and they never continue on with that implementation to then maximize what that solution can give, and that's where it stays for the entire life of that solution. I think in terms of data, to follow on with what Anita's saying. And one of the things that and we'll get into it, I know, but one of the things that I like so much about our solution stack is the data is great when it's in a centralized and consolidated place that can be accessed and utilized and is current. Earlier I was talking about all these tech stacks. Well, in addition to all of these multiple solutions, now you have disparate databases. You've got a database on your POS, you've got a database on your LOS, you've got a database on your CRM, and they're all separate. And you've got to reconcile to those databases, and you've got to ensure that they're accurate and current, and which loan value is the one I use. Do I use the one in my CRM? Do I use the one in my LOS? Do I use the one in my POS? And so I think a lot of organizations struggle just understanding what is the data set, right? What's the solution for that? Well, they then end up building huge data lakes within their organization, and with that comes a tremendous amount of cost, where they're now pulling all of the data into a centralized solution, and now they've got to go through and reconcile what's the most current piece of data that I'm going to use, and what do I get rid of, and what do I keep. And again, with that comes cost. And so I think one of the biggest things that's going to happen here, over the next few months, and when I say few months, 18 months or so, is that I think organizations are going to start taking a really hard look at all of the solutions they put into their data stack. And there's going to be a big shedding of data out of the organization. I think people are going to start getting rid of the shiny objects that they thought they needed, and then they realize I didn't really need that. I was able to do business without that. And maybe I'll be even more efficient. I'm certainly going to be more cost effective without all of these different solutions that I've put on top of the organization. And I think it's going to be a really hard time for tech companies in the next 18 to 24 months, because, there's a lot of companies that we talk to on a daily basis that, they signed renewal agreements at the top of the market. And then the market went like this, and those technology solutions have not been willing to relook at those agreements to be more of a partner to the companies that they're working with. They said, nope, you signed up for this transaction amount at this dollar amount, and we're going to hold you to that, even though those transactions aren't coming to fruition right now. And lenders are going to remember that, unfortunately. And so I think that when it comes time for those technology solutions to come back and say, hey, we're ready to renew your agreement, I think lenders are going to take a hard look at that and say, well, when I really needed your help, you weren't willing to help me. And now I realize I don't really need you. And I think lenders are going to move in a different direction. So I think the technology landscape in lending in general is going to be significantly different in the next 18 to 24 months because of what has happened and the transaction volumes. And I think lenders are going to be very, very cautious about what they sign up for, why they're signing up for it, what they're paying for that, and their ability to change those agreements if and when the markets change and shift. Because what we're seeing now is that there are a ton of lenders that are stuck behind the 8 ball on these huge technology stacks and these huge monthly outlays in terms of bills and people and transactions and maintenance and admin and all of the things that they're now not getting any ROI on. So I think it's going to open the market up for, a lot of different solutions like ours. And I think it's going to change the landscape significantly here.
I think that's a really good perspective and a great outlook as far as what people should be thinking about and how they should be thinking about their tech stacks. Anita, anything to add to what Brad was saying there?
No, I think Brad pretty much summed it up.
Yep. So so when it comes to what lenders need to be doing, it really comes down to one, as you said, Anita, look at the data. The data doesn't lie, right? That's something I've always said, when I was running my branches and regions and, let's look at the productivity data. Let's look at the cost data, and the data doesn't lie, and let's make decisions, executable decisions based on that data. And you'll start driving costs down. Then, as you said, Brad, the other thing that lenders need to be start doing is doing a whole taking a whole inventory of their entire tech stack. What's working, what's not, what are we really leveraging, what aren't we, and let's cut those costs. Unfortunately, to your point, Brad, there's all these things that are intertwined with some of these systems that they've added and piled onto their tech stack, but they might be under a 6-year contract or a 4-year contract, and now they've got to try and negotiate their way out. And I think you're absolutely spot on that a lot of these lenders are already talking about those vendors that are not giving them a way out, and they won't forget. And it's going to work, against the vendor collaboration and partnership that had stood for quite some time within the industry. So I really think that it's a great warning and great advice to be looking at the data in your tech stack, taking a full inventory there. So good things. So let me ask you, if 10, 20 point of sales, add another 20, 30 LOSs that are out there in the marketplace, what then is Take 3 Tech providing to the market? I mean, what are you guys doing so differently? You kind of touched on the fringes there, Brad, but can you give me a little bit deeper, perspective on what you're doing differently to solve this cost to produce issue for lenders? What are the types of tools you're providing? What's your philosophical approach to a tech stack that's really going to provide lenders the opportunity to drive down their costs, and what should they be looking for in these new technology solutions to really drive down the technology costs moving forward? Anita or Brad? Brad, do you want to jump in here?
Yeah, I think one of the things that attracted me to Take 3 and why I wanted to come over here and work with Anita and be a part of this is, I was really impressed with the simplicity of the solution. When I say that, I don't mean it's a simple solution, but the way in which it's delivered is so much different than what historically large LOS or enterprise LOS technologies have tried to push into the organization. And certainly there's a place for that, and there's a home for some of those solutions, but I think we need to get back to a simplified execution of technology. And that's really what Take 3 is. And the Loan Maps technology suite, where there's a CRM and an LOS, a very powerful LOS, and a point of sale, all sitting on the same database, all ready to go for the most part out of the box. There's not many lenders out there that wouldn't be hard pressed to be able to utilize this solution very quickly without this elongated implementation time frame and this organizational changeover and all of the things that can lead to LOS failures. And I've seen a lot of LOS failures, unfortunately, over my time frame. Right, that's just the nature of the business. And so I was attracted to that. I was attracted to the solution and the technology, and I think the thing that I probably most attracted me is the fact that this solution was built by mortgage bankers for mortgage bankers. And there's not a lot of solutions in the industry that can say that. If you go out there, there's a lot of them that are, technology people who don't have any idea about mortgage or think they know about mortgage, looked over the wall 7 years ago and said, oh, what's going on over there? Looks like there's a lot of money to be made over there. And they poured billions of dollars over there and built solutions and did a pretty good job. But at the end of the day, they don't really understand the mortgage business. And sometimes, their solutions show that, or at least their approach to lenders shows that. And so the fact that, Anita has been running, a highly successful mortgage bank for decades, and then built a solution to support that and other mortgage bankers, I thought, man, that's a place I really wanted to be, because there's not a lot of places you can go in the industry from a technology perspective that you can say that about.
Yeah, well said. You're absolutely right, Brad. It's one of the thorns in my side in this industry is, and I have to consult our lenders to explain to them, listen, technology providers are selling software. Their job is to sell software. They may not have ever closed a loan in the business, but they really, they're fairly, with all due respect, they're fairly one-dimensional in some regards. They don't have the experience of manufacturing a loan from origination to actual post-close, or run the risk of actually having to purchase that loan back. So a lot of moving parts there, and I think lenders need to realize that, okay, I need to stop being sold a software, and I need to buy the appropriate software based on what I need for my organization. So I'm with you 100% there, Brad. Anita, you want to share more of your perspective here?
Sure.
What is Take 3 doing that's really different to help solve the costs to produce issue for lenders?
Yep. Thank you. And thank you, Brad. To Brad's point, one of the things that does make us different is our stakeholders are in the business day to day, whether they're top producing loan officers or they're working in shipping and delivery. And, my team has been, amazing with regard to testing modules, giving us feedback and telling us what the users need, because user adoption is critical, to your point. And people need to embrace and want to use the system, not be forced to use the system. But additionally, we have Brad Thompson, and frankly, I was very honored when he agreed to join our organization. But we have top technologists. Our lead developer is amazing. My only hesitation with Brad is that our lead developer's name is also Brad. And I'm like, okay, how's that going to work? But so I think that's a big factor. But back to your question, and starting with the $14,000 cost to produce, with sales of our state-of-the-art CRM is part of the POS and LOS. So that's not the integration. You said earlier, data doesn't lie. Well, data can lie if it's not accurate and timely. I always remember reading a blog in the Chrisman commentary that a company was mapping the wrong data field to their capital markets firm, who was making decisions on hedge positions, and it wasn't good. So having that master data table. Number two, putting information on the cloud. Put your information on the cloud, organize your data. The rule tool is an example. We now have thousands of users on the rule tool. So we simply take information, we read the agency guidelines, we read the investor guidelines, we put the information on the cloud, we articulate it in a manner that's easy for a loan officer, processor, whatnot to digest. And they, with the click of a button on their phone, can get information versus paying a whole product development team for every lender across the United States, or having loan officers standing outside of the really smart person's office to ask a question. Those factors are important. The cost to manufacture. When we were drinking through a fire hose, we had more loans than we knew what to do with.
Yeah.
Negotiating with processors and underwriters, that increases your cost to produce. So I said to myself, like with the rule tool, well, let's just put the information on the cloud and let's use the free technologies that Fannie Freddie give us. And let's help direct the user so they have the information. The loan officer is the one meeting with the family. They're the ones who need the information to know if this is a loan we should put in process or not. So we use we built what we call Augie AI, augmented artificial intelligence. The system will consume the 1003 from the consumer. Then it will run that data against the basic rules that the agencies have to qualify for a D1C, AIM, or CU. It's not just about getting the data digitally verified. If it can't be validated to receive day one certainty or AIM, then what you might ask yourself, what's the purpose? Or if you have a self-employed borrower and it still needs to go through that cycle, do you want to also spend money on digital? But helping them manage those costs, make good decisions. From there, if you validated your data, you're going to have an accurate AUS finding. So and I studied, well, why aren't people reading the DU findings and why? So we simplified the process by removing messages that didn't pertain to the sales team. And we, again, articulate in a manner that an entry-level mortgage banker can understand versus reading the legalese. And then what's really cool is at the bottom, it literally gives them a step-by-step process on what they need to do to obtain and clear the condition with regard to documentation and or calculation. So now as we go back to, as business starts to stabilize and realign, the lenders who use loan maps can make the decision to hire an entry-level mortgage banker. And I think to your point earlier, Keith, we're so ingrained in doing the same thing. But when you bring in new people, they're willing to adopt the processes that you put forth. So, those are just some examples of, what we're doing to help lenders and so to solve for problems, to make sure that the loan that they manufacture can be delivered into the secondary market and or retain your MSR asset and know that you're compliant with reg documentation. One thing I didn't mention, but I think about a lot is FHA, VA, USDA, jumbo. Those really haven't changed. What we're required to deliver in the secondary market is the same as it's been for decades. So when lenders are being told, technology, sometimes technology can help. If you have a Fannie Freddie, that can be digitally verified and validated. But even with that, if the lender's not taking that path that the agencies are giving us, what's the point?
Yeah. Exclamation point right there. That's a very good point, Anita. I know you, and this is just really exciting to hear. I mean, I know you've been developing loan maps with the manufacturing process in mind and how to help drive down those costs and drive up the efficiencies. And that that's the magic, that's the secret sauce that you have, is at the end of the day, you're a mortgage banker. You understand all the nuances and where there's overlap and how lenders are starting to box themselves in with technology. And that's one of the contributing factors to their rising technology costs. So they're really not maximizing the efficiency and effectiveness that technology actually can deliver, almost like being overbuilt, right, from a technology standpoint. So I think that's a really good point, Anita. Thank you. So this has just been absolutely fantastic, very insightful, a good and quite honestly, an honest challenge to lenders in our marketplace to start really thinking about the data, start looking at the data more granularly, start taking inventory of your technology stack. What is really working and what really isn't working? And what's the premise of that technology? Was it built based on just an idea to solve a small problem in the industry, or was it based on their true understanding of mortgage banking and really helping drive efficiency? And then where are you getting in your own way because you're creating a check the checker process, right? So that's some of what I've heard, but highlighting, the kind of, and you guys have really highlighted some of the key changes, paradigm shifts, if you will, that lenders need to start adopting to their strategy, their tech philosophy, their business model, in order to really effectively start driving costs down. I'm also excited really about what you guys are doing for lenders to help with this. So Brad and Anita, I really want to thank you. Any last words of wisdom for our listeners, or anything further you want to underscore or emphasize?
I'll let Anita finish up, but before that, I'll just say, there's a lot of people that are going to start exploring, their tech stacks here, and there's a lot of renewals coming up. And, I would just encourage people to, give us a good look. And one of the things that I told the team early on was, I was sold. Obviously, I came in and wanted to be a part of this, but the more I looked, the closer I looked, the better it got in terms of a technology stack. So give us a look, because the closer you look at us, the better we get. And thank you for having us today, Keith. Really appreciate that.
Well said. Pleasure.
And I would just say, whether you're interested in loan maps or not, I'm happy to answer questions for any lender out there and share my knowledge. And I may not have the answer to the question, but I'm happy to share my 43 years of mortgage banking experience and how I have applied solutions using technology, where technology works, where it may not work, and factoring in, even if you have OCR with data mapping, do you have to pay for the technology and pay for the employee? And, really, where's your cost to produce? But, I'm happy to help our industry, and it's been so good to me, and God has been good to me. So I'm happy to answer any questions, whether people are interested in our technology or not. I just want to see our industry continue to be successful.
Oh, that's fantastic. Great pearls of wisdom, and what a wide open invitation for lenders to be able to reach out to a true professional in the industry who understands your pain and your challenges of running a mortgage company. I mean, there's no better resource than Anita to be able to reach out to. So thank you, Anita, for making yourself available. As you said, whether it's the technology or just you want to brainstorm with you on ideas and strategies. And I think you've got some great perspective and great wisdom to be able to share there. So thank you for that. Folks, you heard it here. If you want to lower cost to produce, really drive down your cost from $14,000 per loan, it's time to break away from traditional lending methodologies. To learn more about our preferred partner, Take 3 Tech, you can check out their website by going to Take 3, that's the number 3, take3tech.com. Until next time, this has been another exciting episode in the Shark Cage. Thanks so much, Brad and Anita. Great having you here today.
Thanks, Keith.
Thank you.
Thank you for joining us in the Shark Cage. To be a guest on a future episode, send an email to info@blackfin-group.com. To find out more about the show or the information provided in this episode, Visit BlackFin Group online at www.blackfin-group.com.